So we'll start with the chapter of return of income and self-assessment. In fact, we started with this chapter yesterday. Only 15-20 days to go. Within 20 days, there will be rains there also. Here, actually, it is not raining because of cyclone, etc. Here, it is raining because of cyclone. No other reason. So, yesterday we started with return of income and self-assessment. Self-assessment means once the previous year comes to an end, during the assessment year, SSC will assess his total income and SSC will assess his tax liability. Once he has assessed this total income and tax liability, he will file his income tax return. He will file his income tax return providing the details of total income earned by him and tax liability. That is called as income tax return. Practically, we call it as return of income. In the law, they have used the language return of income. So the question number one is it mandatory for everyone to file the income tax return? Yes, if they fulfill any of these conditions which are given in section 139 subsection 1. If you fulfill any of the conditions which are given in section 130 and 1, then only it is mandatory for you to file the income tax return. Otherwise, not. What is the due date of filing income tax return? That is also we had discussed yesterday. If you have entered into any international transaction, 30th November. If you are a company whose books or accounts are audited, or you are any other person whose books or accounts are audited under the Income Tax Act, or you are a partner in a partnership firm whose books or accounts are audited, then for you the date is 31st October. Up to last year, this date was 30th September. Now it is extended by 1 month, so it is 31st of October. In any other case, it is 31st of July. In any other case, it is 31st of July. I think these things we have discussed yesterday. Now, today we need to start from section 234F, 234A, etc. 234F. 234F says this is fees for defaulting furnishing return of income. Fees for defaulting furnishing return. Defaulting furnishing return means you have not furnished your income tax return within the due date given year. If you don't furnish your income tax return within the due date given year, then you have to pay fees to the government. And that fees is how much? Fees depends upon two things. Number one, your total income, and number two, whether you are filing the income tax return up to 31st December of the assessment year or after 31st December of the assessment. So this point says where the SSC or where the person who is required to furnish the return of income under section 139 subsection 1 fails to do so within the prescribed time limit under section 139 subsection 1. What is the prescribed time limit in section 139 subsection 1? 31st July, 31st October or 30th November. He shall pay by way of fees following amount. He shall pay by way of fees following amount. If his total income is less than equal to 5 lakhs, then he has to pay fees of 1,000 rupees. Then he has to pay fees of 1,000 rupees. He has to pay fees of 1,000 if he is filing the income tax return after the due date. He is filing the income tax return after the due date. If his total income is more than 5 lakhs, then the fees will depend upon when the income tax return is filed. If it is filed after the due date, definitely there is a fees. But if it is filed up to 31st December, then the fees is 5,000. If it is filed after 31st December, then it is 10,000. Yes. Is that clear? Section 234F. If the total income is less than equal to 1,000 rupees, less than equal to 5 lakhs, you pay 1,000 rupees as fees. If your total income is more than 5 lakhs, fees will depend upon The date on which you're filing return up to 31st December, it is 5,000. After 31st December, it is 10,000. Let us proceed further. Rizwan, fees for filing return means this fee is not paid to a chartered accountant. This fees is for defaulting furnishing return. Means you have furnished return after the due date. Therefore, government is charging you fees. Government is charging you fees. It is like a penalty only. This fees we are not paying to chartered accountant. Government can either charge you interest or penalty or fees. So government has charged you fees under section 234F. This fees you have to pay before filing the income tax return. If you don't pay fees, this fees, your income tax return will not be accepted. Your income tax return will not be accepted if you don't pay the fees. Now we need to move on to section 234A. See, yesterday we understood the interest calculation in section 234B, interest for defaulting payment of advance tax, and section 234C, interest for deferment of advance tax. Here we have section 234A. This is interest for defaulting furnishing return of income. If there is a default in furnishing return of income, then you have to pay interest. So if there is a default in furnishing return of income, then you have to pay fees as well as interest. Yes, you have to pay fees as well as interest. Interest will not be there always. Fees will be there always. Always you have to pay the fees. Interest is required to be calculated on the amount of outstanding tax. If the outstanding tax is zero, say for example you have paid the tax, you have not, you have paid the tax, your outstanding tax liability is zero. Your outstanding tax liability is zero. In that case, there won't be any interest in section 234A because the amount on which interest is calculated, that amount is nothing but tax on your assessed income. Tax on your assessed income. If anyway you have paid more tax, in your case there is a refund. In your case there is a refund. The tax paid by you is more than your tax liability. In that case, there won't be any section 234A interest. But yes, since there is a defaulting furnishing return, definitely there would be a fees. So this 234 interest is for defaulting furnishing return of income. So first of all, we need to understand what is the nature of default or when we can say that there is a default. And number two, if interest is required to be calculated, then interest should be calculated on what amount, at what rate, and for what period. These three things we need to understand. So first of all, what is the nature of default? There is a default in furnishing return. So when can we say that there is a default in furnishing return? In two circumstances, we can say that there is a default in furnishing return. Number one, income tax return is not furnished at all. Income tax return is not furnished at all. Or income tax return is furnished after the due date given in section 139 subsection 1. Either income tax return is not furnished or income tax return is furnished, but it is furnished after the due date given in section 139 subsection 1. In that case, we say that there is a default. If there is a default, you have to pay interest. At what rate? At the rate of 1% per month or part of the month. At the rate of 1% per month or part of the month. On what amount you have to pay interest? First of all, you have to calculate the tax on total income. Who will calculate tax on total income? You might have calculated. Department will once again calculate. Department will calculate your total income. On that, they will calculate the tax liability. From that, they will deduct number one, advance tax, number two, TDS, number three, TCS, number three, relief under section 89, subsection 1, MAT credit, AMT credit, and if you have paid any income tax, during the assessment year, up to the due date of filing return. Up to the due date of filing return, if you have paid any tax, that will also be deducted. Self-assessment tax will also be deducted. So any tax paid up to the due date of filing return, that will also be deducted. So after deducting all these things from your final tax liability, whatever balance amount of tax is left, on that amount you have to pay interest. On that amount you have to pay interest. Have you understood this? Yes or no? So when can we say that there is a default? The fourth point is because of case law. Fourth point is because of case law. Pranav Roy versus Supreme Court, as well as CBDT circular. This is not discussed at CA intermediate level. This will be discussed at CA final level. Still, I have given you as a passing reference. As per point number 4, what it says now? Any income tax which you have paid, see, 100% income tax you are supposed to pay by 15th of March. We also understood that if you pay some tax after 15th of March, but if up to 31st of March, that will also be considered as advance tax. What if you have not paid your 100% tax up to 31st of March? Then you may pay some amount of tax in the assessment year. You may pay the tax at the time of filing the income tax return. So whatever tax you have paid during the assessment year up to the due date of filing return, that will also be deducted. That will also be deducted. Say for example, income tax department has ascertained your tax liability at 1 lakh rupees. From that you deduct advance tax. How much advance tax you paid? For example, 60,000. From that you deduct TDS, TCS, MAT credit, AMT credit. Say for example, that is 20,000 rupees. So from 100, 60 and 20, 80 are gone. Now say for example, you have paid 20,000 rupees during the assessment year up to the due date of filing return. So this 20,000, whether it should be deducted or not, that was the argument. So Supreme Court said that even though this 20,000 is paid during the assessment year, but it is paid within the due date of filing return, now that is required to be deducted. So if you deduct that 20,000 also, then the outstanding tax liability will be 0. And since the outstanding tax liability will be 0, interest will also be 0. Rizwan, have you understood this amount? So 234A interest is for default in furnishing return. Number 1, either you have not furnished the return or you have furnished the return after the due date. In that case, we can say that there is a default in furnishing return. If there is a default in furnishing return, then interest will be levied at the rate of 1% per month or part of the month on the amount of tax liability determined by the income tax department minus the advance tax, TDS, TCS, relief, MAT credit, AMT credit, and minus the self-assessment tax paid up to the due date of filing return. On the balance amount, you have to pay interest. Now the point is, from which period to which period you have to file the, you have to pay the interest. For what period you have to pay the interest? Interest period will start from the date succeeding the due date of return. If your due date of return is 31st July, then your interest calculation will start from 1st August. If your due date for filing return is 31st October, then interest will start from 1st November. If your due date for filing return is 30th November, then your interest will start from 1st December. So this interest will start from date succeeding the due date of return. This will start from date succeeding the due date of return. What is the end period? In case the return is filed after the due date, then the date on which the return of income is submitted. For example, in your case, due date of filing return is say 31st of July, but you have actually filed the return on 31st of December. Then for what period your interest will be calculated? Interest will be calculated from 1st August to 31st December. It will be calculated from 1st August to 31st December. That is August, September, October, November, December. For 5 months, your interest will be calculated. What if the income tax return is not filed at all? If income tax return is not filed, then what? Then also the starting period, starting date of computation of interest will remain the same. That is date succeeding the due date of return. If the due date of filing return in your case is 31st July, then our interest calculation will start from 1st of August. Till what time you have to calculate interest? Till the date of completion or assessment by the income tax department, either in section 144 or in section 147. So, if you have not filed the income tax return, see whatever now I am explaining you, that is part of CA final syllabus assessment procedure chapter. You need not remember. It is just that for better understanding of the provisions or situation I am trying to explain. See, if you don't file the income tax return, and if income tax department has identified that yes, you have not filed the income tax return, in that case, what income tax department will do? They will send you a notice in section 142 subsection 1 clause 1. They will send you a notice under section 142 subsection 1 clause 1, and they will ask you to file the income tax return by giving you a time period of 30 days. They will give you a time period of 30 days and they will ask you to file the income tax return within 30 days. Now, if you don't file the return in response to that notice, you have received a notice from the department saying that we have observed that we have not filed the return within the due date, not filed the return at all. So we request you to file the return within 30 days. If you don't file the return within 30 days, then what will happen? The income tax department will assess your income based on whatever information they are possessing. For example, you might have received a lot of income from different persons, and those people might have deducted your TDS. Those people might have deducted the TDS, and they might have filed the TDS return. They might have filed the TDS return. So in that TDS return, definitely the department will come to know how much TDS is deducted in your case, in which section it is deducted, at what rate it is deducted. So every information department will be having with respect to TDS. If department knows what is the amount of TDS and what rate it was deducted, under which section it was deducted, they can definitely ascertain your income. So based on whatever information department is possessing, they will ascertain your income by taking up the best judgment. As per their judgment, they will do the assessment of your income. Because you are not responding now. If you are not responding, then what? Then the other person has to make the judgment based on whatever information he is possessing. He has to make the judgment. Say, for example, Rizwan has proposed to some girl. Now she is not responding. So what Rizwan will do? He has to make a judgment whether the answer is yes or no. So Rizwan says, whenever I see her, she always smiles at me. So this one is a positive sign. When I give to something, she is also giving me a return gift. This is the second positive sign. So Rizwan will conclude based on the information which he is possessing, based on the behavior. Yes or no? that girl's friend, that girl's other friends, they are teasing Rizwan by taking her name. This is the third sign. So Rizwan will decide based on different factors because she is not responding. She is not responding. Rizwan will decide based on different factors. So similarly, if you have not filed your income tax return, department will send you notice in section 142 subsection 1 clause 1. If you don't respond to that notice in the form of filing the return, then department will do assessment of your income based on the information which they are possessed. That is called as best judgment assessment in section 144. So if you don't file the income tax return, department will send you notice. In response to that notice, you file the income tax return. Thereafter also, if you don't file the income tax return, then department will do your assessment in section 144 or section 147. They will do your assessment either in section 144 or in section 147. Now, for example, you have filed the income tax return after the due date. For example, in your case, due date of filing return is say 31st of July, but you filed the income tax return on 31st of August. At the time of filing return, you already knew that you are filing the income tax return after the due date. So you have already calculated interest for the month of August. You have already calculated interest for the month of August, and you have also paid the interest up to the August. That is, for 1 month you have already paid the interest under section 234A. But this interest is payable up to the date of submitting the return. If you have already paid interest, then no further process is required to be done. But if you have not paid interest, then have you filed the return? Answer is you have filed the return but not paid interest. Then government will levy interest up to the date of completion of assessment. Say for example, you have paid interest partly, you have paid partly, you have not paid. In that case, you have to pay up to the date of assessment. Is that very clear? Interest payable under section 234A shall be reduced by the interest, if any, paid on self-assessment under section 148 towards 234. Means whatever interest, if you have already paid some interest, then that interest will be deducted, balance will be levied. Yes, 234A calculation of interest is clear. Yes. Next is self-assessment. Self-assessment, section 148. Self-assessment means ascertaining your own income. Before you appear for CA Institute examination, you would like to do the self-assessment. So what you will do? You will pick up some question papers and you will sit for the test at home. So you will appear for test from home. Then you will refer to the answer sheets. You will refer to the answers and you will try to match your answers and see wherever you have done the mistake, how many marks you can cut. So you are doing your self-assessment before actually institute does your assessment. Similarly, here also, SSC will first do his self-assessment. He will file the income tax return. Thereafter, income tax department will do the assessment. Thereafter, income tax department will do the assessment. Payment of tax, interest, fees before furnishing return of income. Before you file your income tax return, if any tax is due, if any interest is due, if any fees is due, all these things are required to be paid. If you don't pay this, then your income tax return will not be accepted. Your income tax return will not be accepted. Definitely, this tax liability will be ascertained, take into account taxes which are already paid, TDS which is deducted, TDS tax which is collected, relief under section 89, MAT credit, AMT credit, all these things will be deducted. You will get the credit for everything. Whatever you have paid or whatever others have paid on your behalf, in the form of TDS, TCS, etc., will get credit for everything. Thereafter, if some tax is payable, that tax plus interest plus fees, everything you have to pay. Unless and until you pay the entire amount of tax, interest, and fees, your return will not be accepted. Order of adjustment of amount paid by the assessor. Now the question is whatever 60,000 against tax, or whether that amount is paid for interest, or whether that amount is paid for fees. How this is required to be adjusted? Because from you 50,000 tax was due, 10,000 fees was due, and 20,000 interest was due. So 50 plus 10, 60 plus 20 is 80. 80,000 is due. Now you have paid 60,000, but while paying, it was not mentioned that I am paying this 50 for paying this 60 for what. So government will adjust this 60 against your liability of 80. But government should adjust against what? Should they first adjust against the tax? Should they first adjust against the fees? Or should they first adjust against the interest? Yes, are you understanding the question? Are you understanding the point I'm trying to explain? Yes or no? 80,000 is payable by you in the form of tax, fees plus interest. But you have actually paid only 60. So that 60 is paid against what? Out of 60, 50 is paid against tax and 10 is paid against fees, and the interest of 20,000 is entirely outstanding, or 20 is paid as interest, 10 is paid as fees, and remaining 30 is paid for tax. How this is required to be adjusted? That order of adjustment is already given in the Act. It says where the amount paid by the SSC in section 134, 140A falls short of aggregate amount of tax, interest, and fees payable by the SSC, then amount so paid should first be adjusted towards the fees payable. So you have paid 60,000. Out of 60,000, first 10,000 will be adjusted against fees, and thereafter towards interest. So what is the interest? 20,000. So first you adjust against fees, then you adjust against interest, and then balance you adjust against tax. Why so now? Because if you first adjust against fees, then against interest, then against tax now, then what? That shortfall of 20,000 now will be considered to be tax payable. And since you have not paid that amount now, interest will also be levied on that amount. So whatever 60 you have paid, out of 60, 10 will be adjusted against fees, 20 will be adjusted against interest, balance 30 will be adjusted against the tax liability. In your case, tax liability was 50, out of which 30 is adjusted. So there is outstanding tax of 20. On that outstanding tax of 20, once again they will levy interest. So they want to levy interest. That is the reason intentionally they are saying that first you adjust against fees, then against interest, and then against tax. So you have to remember FIT. You have to remember FIT, fit. Person should be fit, na? So you should remember fit word here. F means fees, I means interest, T means tax. So order of adjustment is fit, fees, interest, and tax. Consequence of failure to pay tax, interest, or fees. If SSC fails to, 9 વાગે ખાવાનું છે ઉતાર નહીં કર 8:30 બનાવ Point number 3. Consequences of failure to pay tax interest fees. If SSC fails to pay whole or any part of tax or interest or fees, then he shall be deemed to be SSC in default. He shall be deemed to be SSC in default. What is the consequence if he is considered as SSC in default? Then income tax department will levy penalty on him, and income tax department can initiate the recovery proceedings against him. Income tax department can initiate the recovery proceedings means they can freeze the bank account, they can freeze his bank account, they can do the auction and sell his assets to recover the amount of tax, interest, fees, etc. This is called as recovery proceedings. There is a separate chapter on recovery proceedings in CA final. But have you understood this self-assessment? Yes. Point 1. This one, point 1 simply says that whatever amount of tax is payable by you, from that we would deduct tax which is already paid by you, TDS which is deducted, TCS which is collected, relief under section 89, MAT credit, AMT credit, everything will be deducted. Thereafter, if some balance remains, then you have to pay. If your tax liability turns out to say 1 lakh rupees, you will not pay 1 lakh rupees to the government. Already you might have paid some advance tax now. Already some TDS would have been deducted and paid to the government on your behalf. So all those amounts you have to deduct and you have to pay only the balance. This one, have you understood? Yes or no? Yes, okay, let us proceed further. Return of loss. Section 130 and subsection 3. Yes, MAT and AMT will not come in the same question. Because MAT is for company and AMT is for other than company. So both cannot appear. One of them may appear. Okay, return of loss. What do you mean by return of loss? The return of loss means you are filing the income tax return in which you are declaring some loss. That yes, you have incurred some loss. You have incurred some loss, that is what you are declaring. In your income tax return, if you are declaring some loss, then it is called as return of loss. See, if you are having a loss, that is negative income, that will definitely adjust against some other positive income. When you adjust your negative income against the positive income, that is called as set off of loss. That is called as set off of loss. After setting off the negative amount against the positive amount, if still some negative amount is remaining and you don't have any other positive amount to set off, then this negative amount can be carried forwarded to the subsequent year. That is called as carry forward of loss. So set off of loss means adjusting the negative income against the positive income in the current year. Carry forward means carrying the negative amount from the current year to the next year. The way you say na, in ledger account, when you close the ledger account, you say carried forward, balance carried forward, balance brought forward. Similarly, at the end of the year, when we file the income tax return, if we have a loss, we'll try to adjust that loss against some other positive income. And if our positive income is not sufficient, then the negative income will be carried forward to the subsequent year. And in subsequent year, that loss will be called as brought forward loss. That loss will be adjusted against some other positive income in the subsequent year. Now the point is, section 130 and subsection 3, return of loss, it simply says that we will allow you to carry forward the loss only if you have filed your income tax return within the due date given in section 130 and 1. What is the due date given in section 130 and 1? 31st July, 31st October, or 30th November, whichever date is applicable to you. If you don't file your income tax return within that due date, what will happen? Then we will not allow you to carry forward your loss from one year to another. Can you set off the loss in the current year? Can you set off the negative amount against the positive amount in the current year? That you can do. But what you cannot do, you cannot carry forward the loss. From the current year to the next year, you cannot carry forward the loss if you have not filed the return of income on time. If you are declaring a negative income in the return, we call it as return of loss. So, if you don't submit the return of loss on time as per the due dates given in section 131, then we will not allow you to carry forward the loss. Set off will be allowed, carry forward will not be allowed. However, there are two exceptions to this. There are two exceptions to this. The first exception is loss under income from house property. Loss under the head income from house property. And number two, unabsorbed depreciation, unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure on family plan. These amounts, even though you have not furnished the income tax return within the due date, even though you have furnished the income tax return after the due date, these amounts will be carried forward. So loss of IFSP will be carried forward. Unabsorbed depreciation, unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure on family planning, this will be carried forward even if you have furnished the return after the due date. So which loss will not be carried forward if you furnish the return after the due date? Your business loss will not be carried forward. Your loss under capital gain will not be carried forward if you furnish the return after the due date. See, salary, you cannot have the loss. House property, you can have the loss, and this loss will be carried forward even if you file the return after the due date. Business profession, capital gain, these losses will not be carried forward if you file the return after the due date. This loss can be set off in the current year, but it cannot be carried forward. Is that very, very clear? Have you understood this? Setting off the loss means adjusting the loss against the gain in the current year. And if your gain is not sufficient enough to adjust the entire loss, that loss will be carried forward. We are simply saying that if you don't file the income tax return within the due date, then your loss under the head business profession, loss under capital gain, and loss because of activity of owning and maintaining resources, this will not be carried forward. Which losses will be allowed to be carried forward even if you file the income tax return after the due date? Income from house property loss will be carried forward. Unabsorbed depreciation, unabsorbed capital expenditure on scientific research, unabsorbed capital expenditure on family planning will be carried forward. So certain losses are allowed to be carried forward only if the return of income is filed within the due date. Which are those losses? Losses under the head PGP, losses under capital gain, or there is a loss from the activity of owning and maintaining resources. The return of loss should be filed within the due date given the section 130 and 1. See here, actually there is a error here. Here, return filed under section 139(3). Instead of 1, you should write 3. Return filed under section 130 and 3 shall be treated as return filed under section 130 and 1. Only thing is, if you are having a negative income and you are filing the return, that is as good as you are filing the return in section 130 and 1 only. So this heading is wrong. return filed under 130 and 3 shall be treated as filed under section 130 and 1. Section 80 says that unless you file the income tax return within the due date, your losses will not be carried forward. But yes, there are certain losses will be carried forward, which will be carried forward even if you file your income tax return after the due date. Those are loss under income from house property, unabsorbed depreciation, unabsorbed capital expenditure on scientific research, and unabsorbed capital expenditure on family plan. This was section 139, subsection 3. Now we move on to section 139, subsection 4, which is called as belated return. This is called as belated return. For example, Dikshit, when is your birthday, Dikshit? When is your birthday? October 6th. What question Sarvana is asking me? If business loss in 1819 is 30,000, filed within due date, and 1920 business loss is 10,000 but filed after the due date, then which loss will be set off in 2021? Business income if both or only 1819? Only 1819 will be set off. Sarvana. See, Sarvana is asking me doubt saying that during the financial year 1819, he is having a business loss of 30,000. During the financial year 1920, he is having business loss of 10,000. So financial year 1819 as well as financial year 1920, he is having business loss of 30,000 and 10,000 respectively. Now, he is not having any other positive income to adjust the loss. So he is carry forwarding the loss from the current year to the next year. But he has filed the income tax return for 1819 within the due date, and 1920 he has not filed the return within the due date. So what is going to happen? 1819 he can carry forward the loss because he has filed the return for 1819 within the due date. 1920 he cannot carry forward the loss because he has not filed the return within the due date. So his 1920 loss of 10,000 will lapse. So what he can carry forward is only 30,000 pertaining to the year 1819, and that he can adjust against the positive income of 2021. Sarvana, is that clear? Okay. Now we move on to section 139, subsection 4. Now Dikshit is having birthday on 6th of October. Dikshit was born on 6th of October. Now say for example, this is the year of 2021 going on. It is the month of May. For example, I did not wish happy birthday to Dikshit in 2020. In 2020, I did not wish happy birthday to Dikshit. So can I wish right now? Definitely yes. In that case, I need to say that belated happy birthday. So after the particular date, after that particular date of birth, if you are wishing someone happy birthday, then definitely you have to say belated happy birthday, because the due date has gone and thereafter you are wishing. But question is still, what time I can wish him belated happy birthday? Can I go to him in the year 2022 and say belated happy birthday for 2019, belated happy birthday for 2020, belated happy birthday for 2021? Can you do this? Definitely not. So belated happy birthday you can wish before the next birthday only. You can wish belated happy birthday before the next birthday arrives. Once the next birthday arrives, you did not wish him in the year 2020. So now if October 21 arrives, then you have to wish him happy birthday for October 2021. In other words, if you wish him after the date of birth, then it is called as belated happy birthday. But that belated happy birthday also will be valid only if it is wished within some time limit. Similarly, here we have something called as belated return. Here we have something called as belated return. Belated return means the income tax return filed after the due date. Any income tax return which is filed after the due date is called as belated return. For example, your due date of filing return is 31st July. You file return after 31st July, that return will be called as a belated return. But the point is, till what time you can file this belated return? Right now it is 2020-21. So can you file the belated return of financial year 11-12? Answer is no. Because there is a time limit to file the belated return also. There is a time limit to file the belated return. I already explained you that if you don't file the return within the due date, and if department has observed that you have not filed the return, what department will do? Department will send you notice in section 142 subsection 1 clause 1. They will give you a time period of 30 days and they will ask you to file the income tax return. In response to this notice, you should file the income tax return. If you have not filed the income tax return in response to notice under section 142 subsection 1 clause 1, then department will do the assessment of your income based on their best judgment, which is called as best judgment assessment under section 144. Now let me give you an example to make you understand this. Say for example, in your case, the due date of filing return is 31st of July. Now we have not filed the return till 31st of July. Then the question is, any return filed after 31st July will be definitely considered as belated return only. There is no doubt in that. But I can file the belated return up to which date? So you have to calculate, you have to ascertain 2 dates. Out of those 2 dates, you have to select whichever is earlier. You have to select whichever is earlier. So first date is before the end of the relevant assessment year. What is your previous year? 2021. What is your relevant assessment year? 21-22. In your case, what is the due date of filing income tax return? For example, it is 31st July 21. You have not filed the return up to 31st July 21. So up to which date you can file the belated return? First date is before the end of the relevant assessment year. In your case, assessment year is 21-22. So end of the assessment year is 31st March 22. So this is the first date, 31st March 22. Or we have a second date before completion of assessment. Before completion of assessment. I already told you that if you don't file the return within the due date, thereafter income tax department can send you a notice under section 142 subsection 1 clause 1 and they can ask you to file the return by giving a time period of 30 days. If you don't respond to that notice by filing the return, then they will do the best judgment assessment. They will assess your income as per the based on the information they are possessing. For example, they have done your best judgment assessment on 31st December 21. So first date is end of the relevant assessment year, that is 31st March 22, and the second is completion of the assessment, 31st December 21. Out of 31st December 21 and 31st March 22, which date is earlier? Definitely 31st December 21 is earlier. So you can file your belated return only up to 31st December 21. In other words, we will not allow you to file the income tax return once the assessment is over. Once the assessment is over, story is over. Whatever income department has assessed, you have to pay tax on that amount. Have you understood this? Yes or no? So we have understood two things here. Number one, what do you mean by belated return? And what is the time limit for filing the belated return? Now we have revised return. What do you mean by revised return? If something is taught to you and if you forget, you revise those things now. Revising means revisiting. Revising means revisiting. So here also meaning is same. If you have filed your income tax return, thereafter, if you feel that there is some omission in the income tax return or there is a wrong statement in the income tax return. For example, you have filed your income tax return. Later on, you realize that you forgot to disclose income from house property. So that there is a omission. Income from house property is not disclosed in the income tax return. There is a omission. Or you have filed your income tax return. Later on, you came to know that interest on FD earned by you is 50,000, but by mistake, due to typing error, you have mentioned only 5,000. So there is a wrong statement. There is misstatement. Your interest income on FD was 50,000. By mistake, you mentioned it as 5,000. So there is a misstatement. So either there is a omission or there is a wrong statement, misstatement. In that case, whatever income tax return you have already filed, that income tax return can be revised. You can file a new income tax return. That new income tax return will replace the old one. It will replace the old one. Say for example, you filed the first income tax return. In that there was a omission, so you filed the second one. In the second one there was a wrong statement, so you filed the third one. In the third one also there was a mistake, so you rectified that mistake and you filed the fourth one. So the question is, you can file the revised return. How many times you can file the revised return? Can you file the revised return 100 times? Answer is yes, till the time you are satisfied. Now, say for example, you have filed a revised return. You have filed 5 times. So first of all, original return was filed. Thereafter, 5 revised return are filed. So income tax department is having 6 income tax return for the same year. Which one they should consider out of 6? Last one which was filed. The 6th one which is filed would be considered as the return, or earlier returns filed. Now 5 returns will be considered as invalid. The final return filed by you will be considered for the purpose of assessment. So you have understood the meaning of revised return. Revised return means submitting a fresh return subsequent to discovery of any error or omission in the original income tax return. Is there any time limit for filing the revised return? Yes, there is a time limit for filing the revised return also. What is the time limit? The time limit is same as belated return. The time limit is same as belated return. Means revised return can also be filed before the end of the relevant assessment year or before the completion of assessment, whichever is earlier. Revised return can be filed before the end of relevant assessment year or before completion of assessment, whichever is earlier. Have you understood this? Yes. Okay. Some important points to be kept in mind with respect to revised return is, a revised return must be considered having been filed when the original return was filed. Say for example, original return was filed on 1st July. Revised return was filed on 1st December. Original return was filed on 1st July. Revised return was filed on 1st December. Will you have to pay 234A interest? 234A interest for what? It is for what? It is for defaulting furnishing return. Na? You have filed your original return on 1st July, but you have filed your revised return on 1st December. Will you have to pay 234A interest? Answer is no. because that revised return would be considered to be filed on the date on which the original return was filed. So you have filed the revised return on 1st December, then also we will consider that this return was filed on 1st July only. So the date of filing of original return, that itself will be considered as the date of filing the revised return. So revised return must be considered as having been filed on the date on which the original return was filed. The effective return for the purpose of assessment shall be the return ultimately filed by the assessor. I told you now you have filed 6 returns, 1 original, 5 revised. Which one will be considered as the final one? The 6th one will be considered. Revised return replaces the original return. Revised return replaces the original return. If the assessor discovers any omission or wrong statement in the revised return, he is also entitled to file the second revised return. Revised return can also be revised. Next is defective return. Next is defective return. Now listen to me very carefully. I am going to give you a very simple example to understand the concept of defective return. And then we'll move on to understand what is this section 130 and subsection 9. Say for example, Ishwar has completed his 10th standard. He has passed the 10th standard examination. So now he has to take the admission in college. See, in Chennai, 11th standard, 12th standard, both are considered as part of school education only. In Gujarat also, 11th standard, 12th standard is considered as part of school education. But in Mumbai, school education is up to 10th standard. 11th, 12th standard would be forming part of your college education. Now, after 10th standard, you have to take admission in college. Most of the places in entire country, 11th, 12th is part of college only. Junior college is part of school only. Most of the places in the country, junior college is part of school only. Exceptionally, I think in Delhi and Mumbai, the junior college is considered as part of college. Generally, wherever you are studying, in whichever school you are studying in 10th standard, in that same school you will have to take, in the same school you will take admission for 11th standard. But here in Mumbai, once you complete 10th standard, your school is having only up to 10th standard. Then you go to some other college and get the admission for your 11th standard. Now say for example, Ishwar has passed his 10th standard examination. So now he has to get the admission for 11th standard in a college, in a junior college. So he is going to college to take the admission. So he will go to the college, he will fill up the admission form. Along with the admission form, he is expected to submit his 10th standard mark sheet. He is expected to submit his Aadhaar card. He is expected to submit the fees check. All these things he is expected to submit now. For example, he has filled up the form. He has submitted the true copy, photocopy of his mark sheet of 10th standard. He has submitted the check of fees. He has submitted the copy of Aadhaar card. Everything has done. But the application form, he forgot to write his name only. In the application form, he forgot to mention his name. So that name column is left to blank. The row in which name is required to be written, that is left blank. In that case, what should college do? Should the college give him admission? Should college rectify his mistake and give admission to him? So they say, no, we will not rectify his mistake. We have his Aadhaar card also. We have his mark sheet also. On Aadhaar card as well as mark sheet, the name is written. But why should we rectify? Who has done the mistake? Ishwar has done the mistake now. He has to rectify this. This mistake comes to the knowledge of the college. College will inform the mistake to the Ishwar. And Ishwar has to rectify the mistake. Ishwar's application is considered to be defective application. See, if you observe in the college application form while taking the admission, the form which you fill up, that application form, they clearly mention. They put the asterisk mark on every column. Wherever they want you to furnish the information mandatorily, they'll put the asterisk mark. If you don't fill up the information in those asterisk mark, then your application will be considered to be invalid and it will be outrightly rejected. That is what they clearly mention in the application form. So, in their application form, wherever they have put an asterisk mark against whichever row or column, you have to fill up the information. If you don't provide the information, then your application would be outrightly rejected. In simple language, we can say that your application will be considered to be defective application. Another point is, say for example, he has filled up the form correctly, he has paid the fees check also, but he has not submitted the mark sheet of 10th standard. In that case, his application will be considered to be defective, because if they accept the application and give him admission, then people will directly take admission 11th standard after 7th or 8th standard. Why there is a need to appear for the 10th examination? So definitely mark sheet copy is also required to be submitted. He has not submitted. His application will be considered to be defective. He has submitted the mark sheet, but he has not paid, given the fees check. In that case also his application will be considered to be defective. So when can we say that your application is defective? Either you have not filled all the compulsory information, or along with the application, you have not given certain documents, certain attachments you have not furnished. In that case also your application will be considered to be defective. And if your application is considered to be defective, college will come to know about this defect and college will intimate you about this defect. And college will give you a time period of say 15 days. And college will ask you to rectify this defect. You come to the college, you go to the college, go to that counter, ask for that form. In that you rectify your mistake and you resubmit the form. A time period of 15 days is given to you. In those 15 days, if you rectify your mistake, if you rectify your defect, then your application would be considered to be valid application. Your application would be considered to be valid application. But for example, during 15 days time period was given to you to rectify the defect, but you have not rectified the defect in that 15 days. Then thereafter your application would be considered to be invalid, as if application was never submitted. As if application was never submitted. Now, for example, you filled up the application form and you went to your native place for 1 month holiday, for 1 month vacation, you went to your native place. Now the college has identified that yes, you have done the mistake. In the application form, there is a mistake, there is a defect. So college is writing a letter to you saying that kindly rectify this mistake within a period of 15 days. That letter is sent to your house, but you are not there present. You are not present in your house. At your place, you are not present because you have gone to your native place for a vacation. When you come back from vacation, you realize that college has written letter twice to you. And now the time limit to rectify the defect has expired. So your application is considered to be defective as if it was never filed. Your application is rejected. Now you won't get admission in that college. So in that case, what you can do? You can go to the college and you can explain, sir, please allow me to rectify my defect. Actually, I was not there at my house. I actually went to my native place for 1 month. So I did not realize that you sent a letter to me to rectify the defect. So college will say that show us the proof that you are gone to your native place. So you showed them the railway ticket. See, this is the ticket, just yesterday I have come. So in that case, it is up to college whether they want to allow you to rectify your mistake, giving some extra time to you, or whether they want to reject your request. If they feel that it is a genuine case, they may allow you to rectify the mistake. And in that case, you rectify the mistake and our application will be considered to be valid. If they feel that you're trying to fool them, then they will say that no, time limit has already expired. Now you go to some other college and take the admission. In that case, or the application is outrightly rejected, means as if it was never filed, you will not get any admission. So this is called as defective application. Similarly, in income tax, we have a concept of defective return. In income tax, we have a concept of defective return. While you file your income tax return, you have to pick up a income tax return form whichever is applicable to you. There are different income tax return forms. You have to pick up the income tax return form whichever is applicable to you. You have to fill up all the mandatory fields. Along with the income tax return, you have to submit the copy of manufacturing account, trading account, profit and loss account, balance sheet. If you have maintained the books of accounts, if you are required to maintain the books of accounts as per section 44AA, then you have to submit the copy of manufacturing account, trading account, profit and loss account, balance sheet. If you are a sole proprietor, you have to submit the copy of proprietor's capital account. If you are a partnership firm, you have to submit the copy of partner's capital account also. You have to submit the copy of partnership deed also. Whatever TDS credit you are claiming, whatever TCS credit you are claiming, for that you have to submit the copy of TDS and TCS certificate. Whatever advance tax you have paid, you are claiming credit for those advance tax. You submit the challan number through which you have paid the advance tax. All these things are required to be submitted. If you don't submit these attachments, or you don't pick up the appropriate income tax return form, and if you don't fill up the income tax form correctly, then your income tax return will be considered to be a defective income tax return. What will happen in that case? In that case, income tax department will send you a notice saying that your income tax return is defective. We are giving you a time period of 15 days. You rectify the defect within 15 days. If you rectify the defect within 15 days, your income tax return will be considered to be valid. If you don't rectify the mistake within, if you don't rectify the defect within 15 days, because of some genuine reason, then department may give you some extension. Department may give you some extension. Only in genuine cases they will give the extension. In that case, you rectify the defect within the extended period. And if you don't rectify the defect within the extended period, then it will be considered that you have never filed your income tax return. Your income will be considered to be invalid. And department will do the assessment on their own. Department will do the assessment on their own. Yes, is that very, very clear? So let us now move on to this section 139 subsection 9. Return will be considered to be defective by the assessing officer in the following circumstances. Number one, when the annexures, statement or columns in the income tax return are not duly filled up. Number two, return of income is not accompanied by the computation of total income statement. It is not accompanied by the proof of payment of tax like TDS certificate, TCS certificate, proof of advance tax paid. All these things are not attached with the income tax return. If your books of accounts are required to be audited, then the audit report copy is not attached. Where the regular books of accounts are maintained, then copy of manufacturing account, trading account, profit and loss account, income and expenditure account, copy of balance sheet is not furnished. If you are a proprietor, then personal account of proprietor or copy of partner's capital account in case of firm is not furnished. If the accounts are audited and the copies of audited statement of account and auditor's report furnished. If the cost audit is done, then cost audit report is not furnished, your return will be considered to be defective. And if you do not maintain the books of accounts, you are not required to maintain the books of accounts. In that case, certain information is required to be given. Like what is the turnover, gross receipt in your case? What is the amount of gross profit, expenses, net profit? What is the debtors balance, creditors balance, stock in trade, cash balance? All this information you have to give. All this information you have to give. So if you are not maintaining the books of account, certain basic information like your gross receipts, gross profit, expenses, net profit, debtors balance, creditors balance, stock in trade balance, and cash balance. This is required to be given. Is that very clear? If you have not furnished this information, your income tax return will be considered to be defective. Income tax department will send you a notice of defect. Within 15 days, you rectify the defect, or within such extended time which is given to you by the income tax department in genuine cases, you rectify the defects. If it is not so rectified, then income tax officer, assessing officer shall treat that return of income as invalid return. However, if assessor rectifies the mistake, then income tax return will be considered as a valid income tax return. Is that very clear? Now there are certain very small sections which are not relevant for the purpose of examination. Section 139C. 139C is a section which is giving the powers to CBDT. This is the section which is giving power to CBDT to make rules, saying that following documents are not required to be submitted. Like certificate, TCS certificate, all these copies are not required to be submitted. Such rules can be made by the CBDT, and such powers are given to CBDT by section 139C. Whether CBDT has made such rules? Answer is yes. CBDT has made such rules. Power of CBDT to frame rules. CBDT may frame rules providing for class of persons who shall be required to furnish the return in electronic form and manner in which the return in electronic form may be furnished, document, statement, etc. It should be produced before the income tax officer when demanded. So there are two sections, 139C and 139D. 139D is giving powers to CBDT to make rules with respect to filing the return electronically, and 139C is giving power to CBDT to make rules saying that following documents are not required to be attached along with the income tax return. Whenever income tax officer feels like demanding a document, they will demand document from you. At that point of time, you should submit the document. So whether the CBDT has met the rules? Yes, CBDT has met the rules. Nowadays, most of the income tax return are filed online only. And in an online return, you are not required to submit TDS certificate, TCS certificate, etc. You should keep those certificates with you only. Income tax department is definitely having the details of TDS deducted in your case, TCS collected in your case. So they will accordingly give you the credit. Then we have some section 139A, which talks about PAN number. Is it mandatory for every person to apply for PAN number? Is it mandatory for a person to apply for PAN number? Is it necessary that everyone should have a PAN number? Answer is no. But yes, if certain conditions are fulfilled, then you should get the PAN number. If certain conditions are fulfilled, then you should get the PAN number. Which are those conditions? Number one, if your total income is more than the basic exemption limit. So in your case, basic exemption limit is, say, for example, 2.5 lakhs. So if your total income is more than 2.5 lakhs, then you have to apply for the PAN number. By which date you have to apply for the PAN number? On or before 31st May of the assessment year. On or before 31st May of the assessment year, you have to apply for the PAN number. What if your total income is less than the basic exemption limit? Then also you will be required to apply for PAN number if your sales turnover or gross receipts is more than equal to 5 lakhs. Dikshit, that will discuss. Don't worry. If you want to open a savings account, you need a PAN number. There are a lot of transactions. If you want to enter into any of those transactions, you cannot enter into those transactions without PAN number. So if your sales turnover or gross receipts is more than or equal to 5 lakhs, then you have to apply for PAN number, and you have to apply for PAN number before the end of the accounting year. That is before the end of the relevant previous year. Point number 3, if you have entered into any financial transaction for 2,50,000 or more, if you have entered into a financial transaction, every resident person except individual who enters into a financial transaction, amount aggregating to 2,50,000 or more in a financial year should apply for PAN number before 31st May of the assessment date. Point number 4 says all those persons which are connected to point number 3, they should also apply for PAN number. For example, in point number 3, there is a HUF. HUF has entered into a financial transaction of 2,50,000 or more. Then who are the people who are connected to HUF? Karta is connected to HUF. So Karta should also apply for PAN number. Even though otherwise Karta is not required to apply for PAN number, but if it is mandatory for HUF to apply for the PAN number, then Karta should also apply. If it is mandatory for company to apply for PAN number, then the managing director and director should also apply. If it is mandatory for the partnership firm to apply for PAN number, then partner should also apply. If it is mandatory for the trust to apply for PAN number, trustee, author, founder, these people should also apply. No, co-partner is not written. Only Karta is written, not the co-partner. Yes. So, if any of these entities have entered into a financial transaction for 2,50,000 or more, then people connected to these entities should also apply for the PAN number. In case of HUF, only Karta should apply, not the co-partners. In case of a charitable trust, they should apply for the PAN number on or before the end of the relevant previous year. On or before the end of the relevant previous year, they should apply for PAN number. Section 130 subsection 1A. Notified persons by whom any tax duty is payable should apply for PAN number. See, government by making section 139A subsection 1A has given powers. Income Tax Act, in this section, the Income Tax Act has given power to the government and the CBDT to issue the notification and say that following persons will be required to apply for the PAN number. Even though you are not covered in 5 preceding points, you are expected to apply for PAN number if you are an exporter, or if you are an importer, or you are a SSC under Central Excise, Service Tax or Sales Tax. Now GST. See, GST number itself is based on PAN number. GST number itself is based on PAN number only. In your GST number, PAN number is part of your GST number. So nowadays, practically it is not possible that you are registered in GST and you are not having the PAN number. Earlier it was possible. Section 139 is subsection 1B, notified persons can apply for PAN number. So whenever government notifies that yes, following person should apply for PAN number, in that case we should apply for the PAN number. Section 139 is subsection 2 says assessing officer may allot the PAN number suo motu. Say for example, assessing officer feels that few class of people they are avoiding the tax and they are also not having the PAN number. In that case, assessing officer can give you PAN number without you asking for it. Without you asking for it, assessing officer may allot PAN number to you. So assessing officer has the right to allot you PAN number suo motu. Any other person may also apply for PAN. Any other person means whoever is not covered by the preceding points, whoever is not required to apply for the PAN. But nowadays the PAN number is used as an identity card. So if you want to apply, even though it is not mandatory for you to apply for PAN number, if you want to apply, you can apply. Most of the people will be having PAN number. Yes, out of you having, how many of you are having PAN number? Yes. Any one of you having PAN number? Yes, a lot of people are having PAN number because nowadays applying for PAN number has become very easy. You have to just fill up one form and the fees is within 100 rupees. And the moment you apply for PAN number, within 15 working days, the PAN number will be sent to your registered address. I still remember 300 rupees. Okay, now the fees might have increased. If you apply through agent, then it is 300. Otherwise, I think it was 100. it is something like 88 rupees plus GST. It is something 80 or 90 rupees plus GST. If you apply through some agent, then he may charge fees to you. So you give him 300 rupees, he will apply for PAN number on your behalf. If yes, Sarvana says correctly. Sarvana has given the correct amount. Sarvana says if you apply online, you have to just pay 110 rupees. That 110 rupees will definitely include 18% as GST. So if you apply online through the NSDL website, you have to just pay 110 rupees. The point is, I wanted to tell you that if you talk about 15-20 years back, that is late 1990s, if you apply for PAN number, there was no centralized system to allot the PAN number. PAN number applications were submitted manually. Write an application in your own words and submit. Then they will give you the application number. Once you have submitted the application number, PAN number will be allotted to you. Allotment of PAN used to take 1.5 years to 2 years. Now the system is streamlined. Everything is online through computerized. You have to just fill up the form, make the online payment. Within 15 days, PAN number will be allotted. I think now department is going to come out with more much faster approach. Within a day's time, within 24 hours, PAN number will be allotted to you. You wait for some time, 1-2 years, immediately they will give PAN number to you. The moment you apply, within an hour, at that point of time, PAN number will be allotted to you. Because it is system generated only. Once you submit the application, number gets generated automatically, PAN number will be given to you. PAN card will be sent to you within 15 days. Sarvana says yes, digitalized within 1 day. So within 1 day only PAN number is generated. Not within 1 day also, the moment you submit the application, your application is punched in the system. System will automatically generate the PAN number. And that PAN number can be given to you. PAN card they will send you, because making a PAN card will take some time. So they will send you the PAN card copy within 15 working days. Anyway, once you have received the PAN number is like a roll number. PAN number is like a roll number in the college. In your class, say for example, in a particular class, there are 5 different persons having the same name Sarvana. So if the teacher enters the class and says, Sarvana, get up, then 5 students will get up at the same time. Which Sarvana she is calling? So people will get confused unnecessarily. Which Sarvana she is calling, only she knows. That is the reason roll number is given. So roll number is a unique number. No one else will have the same roll number. Similarly, PAN number is a unique number. No one else in this country will have same PAN number as yours. So once the PAN number is allotted to you, whenever you do any communication with the income tax department, you have to mention the PAN number. So if you file the income tax return, mention the PAN number. In certificates, in TDS, TCS certificate also, the payer and collector will mention your PAN number. If you do any correspondence with the department, mention the PAN number. When you pay the advance tax, in the challan, you mention the PAN number. Besides, here we are having the prescribed list of transactions. Here we are having the prescribed list of transactions. If you don't have the PAN number, it is necessary for you to have the PAN number if you want to enter into these transactions. If you want to enter into this transaction, it is mandatory for you to have the PAN number. There are 18 points. If you refer to these points now twice or thrice, you will not remember everything. Examiner may ask you a question, list down any 5 transactions in which mentioning PAN number is mandatory. So out of these 18 points, you can mention any 4 or 5 points. Purchase and sale of motor vehicle other than 2-wheeler. If you buy 4-wheeler, then you have to give the PAN number. That is what we have also discussed in TCS. If you purchase a motor vehicle, value is more than 10 lakh, then the other person, dealer, will also collect 1% TCS. COVID rate is 0.75%. But in any case, even if the value of vehicle is less than 10 lakh, na, you have to give the PAN number to the dealer. Dealer will not sell you the car if you don't have the PAN number. In India, people are smart enough. Sometimes what people will do now, they will give the PAN number of their neighbor. While purchasing the car, they will give the PAN number of their neighbor. That is what people were doing. Purchase and sale of motor vehicle, opening a bank account, that is savings account with the bank, applying for debit card or credit card, opening a demat account. For all these things, you need a PAN number. If you are paying a hotel bill exceeding 50,000 at any one time, you stayed in a hotel and the bill is more than 50,000. If you are making payment of more than 50,000, yeah, you should have a PAN number. If you are making a cash payment exceeding 50,000 in connection with travel to any foreign country, see, this year onwards, already this section of TCS is also introduced now. For a overseas tour operator, TCS is also introduced. So up to last year we had this provision. And you also know that if your foreign travel expense is more than 2 lakhs, then it is mandatory for you to file the income tax return. Here this point says that if you are making a cash payment of more than 50,000 for a foreign travel, then you should apply for the PAN number. If you want to invest more than 50,000 in purchase of mutual fund units, you should have the PAN number. Payment to a company or institution for acquiring bonds, debentures for amount exceeding 50,000. Amount exceeding 50,000, you want to purchase bonds, debentures, you should apply for PAN number. Payment to RBI for acquiring bonds exceeding value of 50,000, apply for PAN number. You are depositing cash in your bank account with a cooperative bank, post office, etc. You are depositing more than 50,000 in cash in one day, you should have the PAN number. Cash payment for purchase of bank draft, pay order, banker's check for an amount exceeding 50,000 in one day's time, you should have the PAN number. Time deposit exceeding 50,000 or aggregate time deposit exceeding 5 lakhs during the financial year with the bank, post office, Nidhi or NBFC fund, you should have a PAN number. Payment in cash or by bank draft or pay order or banker's check by one or more prepaid instruments exceeding 50,000 in a financial year, you should have a PAN number. Life insurance premium payment exceeding 50,000 during one financial year, you should have the PAN number. Sale purchase transaction in securities exceeding 1 lakh rupees per transaction. Sale purchase transaction in securities exceeding 1 lakh rupees per transaction, you should have a PAN number. Sale purchase of unlisted shares exceeding 1 lakh rupees per transaction, you should have a PAN number. Sale purchase of immovable property exceeding 10 lakh rupees, you should have a PAN number. And the last one, if you are not covered the point number 1 to 17, if you are not covered in all preceding points, then you can be covered in point number 18 if you are selling or purchasing goods or services other than specified above exceeding 2 lakh rupees per transaction. So any transaction, if you are entering into any transaction other than those 17 mentioned above, and the transaction value is more than 2 lakh per transaction, then you should have the PAN number. If you don't have the PAN number, then what? Can you enter into this transaction? Answer is yes. In that case, you have to submit the declaration saying that I am not having PAN number. You have to submit declaration in form number 60 saying that I am not having a PAN number. It is not mandatory for you to apply for PAN number. Na? Only if you fulfill certain conditions, then it is mandatory for you to apply for PAN number. Say for example, your income is not exceeding basic exemption limit. You have not entered into a financial transaction of 2,50,000 or more. You are not covered by section 139A subsection 1. Then it is not mandatory for you to apply for PAN number. So if you are not having the PAN number, doesn't matter. You can still enter into these transactions without PAN number also. But in that case, you have to submit the form number 60. You have to submit the form number 60. It is a declaration that I am not eligible to apply for PAN number. Minor person should quote the PAN number of a parent or a legal guardian. Minor child, minor person, if he doesn't have the PAN number of his own, then he should quote the PAN number of his parent or guardian. Non-applicability of Rule 114B. The provisions of this rule shall not apply to following class of persons, namely central government, state government, consular officers, or non-resident person in respect of a transaction other than those mentioned in serial number 1, 2, 4, 7, 8, 10, 11, 8, 10, 12, 14, 15, 16, 17. If the person is non-resident and he has entered into any transaction other than this mentioned here, then he need not have a PAN number. If you are having a PAN number, once you have applied for PAN number and you received the PAN number, this PAN number should be informed to the people who are deducting your tax. The payer who is paying you income and deducting your tax, you should inform your PAN number to him. If some collector is collecting your tax, then you should inform your PAN number to the collector. The deductor will mention your PAN number in the TDS certificate. Collector will mention your PAN number in the TCS certificate. Seller or lessor will mention the PAN number in the TCS certificate. The requirement to inform the PAN number to collector and deductor is not applicable if you does not have any taxable income. If you don't have any taxable income, or you are not required to obtain the PAN number, then in that case there is no question of submitting the PAN number to the deductor of the collector. Yes, is that very, very clear? Yes or no? Interchangeability of PAN number with the Aadhaar number. This is with effect from 1st September 19. If you don't have the PAN number, don't worry about that. You submit the copy of Aadhaar number. Now you might know that, you might be knowing that when you apply for the PAN number, you have to mention the Aadhaar number. If you don't have the Aadhaar number, and if you have the application number for Aadhaar, that also you can mention. And it's mandatory for you to connect your Aadhaar number and PAN number. Online, you have to go to the income tax website and you have to connect your Aadhaar number and PAN number. That is called as linking the Aadhaar number with the PAN number. Therefore, now government has come out with a provision saying that if you have not submitted the PAN number, instead of that, if you submit Aadhaar number, that is also fine. Quoting and authentication of PAN or Aadhaar. See, whenever you there are a lot of people who have the access to the PAN number data and Aadhaar number data. So when you submit the PAN number, those people will see whether the PAN number submitted by you is correct or not. That is called as know your customer norms. So when you submit the PAN number to a mutual fund, you invest money in mutual fund, you submit the PAN number to the mutual fund. Mutual fund might have the access to the PAN number data, just the name and PAN number. So they can cross verify whether the number. It is mandatory for you to quote the Aadhaar number, or when you apply for Aadhaar number, you will get a enrollment ID for Aadhaar. So when you apply for the PAN number, it is mandatory for you to either quote the Aadhaar number, or you have to quote the enrollment ID which you have received while you submitted the application for Aadhaar. You might have received some enrollment ID. That enrollment ID is required to be quoted. These questions are not asked in the examination. Circular number 6 of 2019, with effect from 1st of 19, this is applicable. It says CBDT has clarified that it is mandatory to quote Aadhaar number while furnishing the income tax return, unless you are exempted. I told you now, you have to link your Aadhaar number with the PAN number. Intimation of Aadhaar to the prescribed authority. If you don't see intimation of Aadhaar to prescribed authority, means linking your Aadhaar number to the PAN number. You go to the income tax website and link your Aadhaar number with the PAN number. Consequences of failure to intimate Aadhaar number. If you fail to intimate your Aadhaar number at the time of PAN application, first of all, they will not accept the application. And if at all already you have PAN number, and now you don't link your Aadhaar number to the PAN number, then your PAN number will be considered to be invalid. Provisions not to apply to certain persons or class of persons. For example, this is only for a knowledge. This topic examiner is not going to ask in the examination. Quoting of Aadhaar number 130 and AA, such simple topics won't appear in the examination. The provision of section 130 and AA relating to quoting Aadhaar would not apply to such class of persons which are notified by the central government. So central government has issued notification number 37 in the year 2017, which says that the provisions relating to quoting of Aadhaar would not apply to an individual who does not possess the Aadhaar number or enrollment ID and is residing in the state of Assam, Jammu and Kashmir and Meghalaya. If you are residing in the state of Assam, Jammu and Kashmir, Meghalaya, you don't have the Aadhaar number, then it is not necessary for you to quote. Or you are a non-resident as per the Income Tax Act 1961, or your age is 80 years or more at any time during the previous year, or you are not a citizen of India, then it is not mandatory for you to apply for Aadhaar number. If you have not applied for the Aadhaar number, then forget about quoting the Aadhaar number. There is no need for you to quote the Aadhaar number. There is no need for you to link your Aadhaar number to the PAN number. So let's move on to section 139B. Section 139B, new scheme for facilitation of submission of income tax return to tax return preparer. This section was introduced somewhere around 2007. Why it was introduced now? These practicing chartered accountants who are in practice, they were charging 2,000, 3,000 rupees as fees for filing the income tax return. And those people whose income is somewhere near to the basic exemption limit, say for example, someone's income is at that point of time, there was no section 87A rebate. Section 87A rebate is just introduced 7-8 years back. Before that, there was no section 87A rebate. Now, say for example, basic exemption limit is 2,50,000 and person's income is only 2,70,000. So on that extra 20,000, he has to pay only 5% tax, that is 1,000 rupees. Now he has to file the income tax return. For that, he goes to a chartered accountant, and chartered accountant is charging him 2,000-3,000 rupees. So his tax liability is only 1,000 rupees, and 2,000-3,000 he has to pay to a chartered accountant in the form of fees. So these people were not in a position to afford the fees of a chartered accountant, because they used to say that the fees charged by the chartered accountant is even more than our tax liability. Therefore, these people whose income is very much near to that basic exemption limit, they stopped filing the income tax return. They stopped filing the income tax return, as a result of which number of people who are filing the income tax return went down drastically. So those people whose income was near to the basic exemption limit, they stopped filing the income tax return. Number of income tax return filers went down drastically, and these people in future, if their income increases, then also there is a doubt whether they will file the income tax return or not, because they are not filing since last many years. So government came out with an amendment. Government came out with a separate course called as tax return preparer course. Government came out with a separate course called as tax return preparer course. Any person who is a graduate from any stream, except science, can join this tax return preparer course. There is a separate website called as trpscheme.com. On that website, you register yourself. Government has done tie-up with NIIT and lot of other institutes. You have to do registration. Go to that institution. They will provide you some training with respect to what are the different heads of income, what are the deductions, all this income tax they will teach you. Thereafter, they will also teach you how to file the income tax return. All those training will be given to you. Thereafter, you have to appear for the examination, MCQ based examination. Once you clear the examination, you will get the license number. Using that license number, you can file the income tax return for individual and HUF, provided they are not covered by the tax audit provision. So, with this tax return preparer scheme, government came out with a solution to offer the services at a very low cost. Fees charged by this TRP license holders does not exceed 500 rupees also. So now those people whose income is around near to the basic exemption limit can also afford the fees, because they can file the income tax return through tax return preparer. So this section came into existence in the year 2007. It was asked in the examination in the year 2007. Thereafter, this is never asked. But since nowadays CA Institute has devoted 30% marks to MCQs, we are not skipping anything, we are discussing everything. So section 139B provides that for the purpose of enabling any specified class of persons to prepare and furnish the income tax return, CBDT by way of notification framed a scheme providing that such persons, individual HF, may furnish their income tax return through the income tax office, through the person called as tax return preparer. If you want to file your income tax return, say for example, your parents want to file the income tax return at a very low cost, then you can go to trpscheme.com website. On that, there is a locator. You just put your PIN code and submit. You will get the list of TRP officers residing in that area, along with the contact details. You call up any one of them saying that I want to file the income tax return. They will come to your residence. They will collect the necessary documents. They will file the income tax return on your behalf, and they will also give you the acknowledgement. And they would not charge more than 500-600 rupees. This scheme is not applicable to company or person whose books of accounts are required to be audited, or a person who is non-resident person. So which person can file the income tax return through tax return preparer is only individual and HUF, provided their books of accounts are not required to be audited. This TRP scheme specifies that who can join the TRP course and what are the guidelines or what are the code of conduct of TRP. Everything is mentioned in the scheme. This tax return preparer can be individual other than following. means following persons cannot join TRP course. Number one, a officer who is a person who is working as an officer of a scheduled bank with which SSC is having a current account or with which SSC is having a regular dealing. That officer of a scheduled bank cannot do a TRP course. Legal practitioner means lawyer, chartered accountant cannot do a TRP course, or employee who is a specified class of person. See, if lawyer and chartered accountants are allowed to do this TRP course, then what is the point of creating an alternative? The objective of this scheme itself will be lost. Therefore, we say that chartered accountant and lawyer, legal practitioner cannot do the TRP course. Point number 5, scheme notified under the said section shall provide the manner in which tax return preparer should be authorized, educational qualification of TRP holder, training and other conditions, the person to act as TRP, the code of conduct, duties and obligations, circumstances under which authorization given to TRP may be withdrawn. All these things should be mentioned in the scheme, and already these things are mentioned. If you go to the trpscheme.com website, then everything would appear. Educational qualification of TRP. TRP should be an individual who holds a bachelor degree from any recognized Indian university or institution, or has passed intermediate level examination conducted by Institute of Chartered Accountants of India or Institute of Company Secretaries or Institute of Cost Accountant. He shall also be eligible to act as TRP. Chartered accountant cannot do this course. A student who has passed intermediate and he has decided he don't want to appear for CA final, he want to discontinue the CA, CS or CMA course, then he can definitely join the TRP, give the examination, become a license holder, and file the income tax return for individual and HUF whose books or accounts are not required to be audited. An eligible person, individual HUF, cannot furnish a revised return of income for an assessment year through TRP unless he has furnished the original return through TRP. If you want to furnish the revised return through TRP, you should have furnished the original return through TRP only. Then only you can furnish the revised return through TRP. Last one is section 140. 140 talks about verification of return. Before the year 2014, before the year 2014, instead of the word verification, it was the word signing of return. So every income tax return is required to be signed by a specified person. Now, there were arguments saying that, see, whenever you file your income tax return, whatever information you are submitting should be a correct information, genuine information. It should not be incorrect information. So whenever income tax return was filed, a lot of people were providing information to the income tax department. And in few cases, income tax department found out that this information is not correct. So they called up the SSC saying that you have submitted this information. This is incorrect information. How did you submit the incorrect information? He says that no, I have not submitted. My chartered accountant has submitted. So income tax officer said him that you have signed now, you have put your signature. So he said that, oh, I have put the signature now. So actually he asked me to put the signature. So I have put my signature there. So income tax department says that you should have verified and signed now. You should check now what is there in the information. Then only you should put your signature. So some people used to argue that in section you are just asking to put the signature. Are you asking us to verify and then put the signature? No. Then how you are arguing with us? You asked us to sign and we have signed. That's all. Income tax return. To be correct. So in different cases, different persons are authorized to verify. In case of individual, he himself should verify his send his before he has appointed someone as this is budget 20 amendment. Sometimes the designation is not director, designation is employee. In that case, employee can also verify the return because he is authorized to do so. He is authorized to do so. When a company is non-resident, person who is holding valid power of attorney, when the company is under liquidation, the liquidator, when the company's management is taken over by the government. For example, Satyam Computers, when the scam came when the scam came out in the open, the management of Satyam Computers was taken over by the government. Then the principal officer of the government has to verify the income tax return. Where the application for corporate insolvency process is admitted, then the insolvency professional should verify the return. In case of a partnership firm, managing partner should verify the return. Where a managing partner is unable to verify or there is no managing partner, any other partner not being minor can verify the return. In case of limited liability partnership, designated partner should verify the return. Where there is no designated partner or designated partner is unable to verify, any other partner of LLP or as per budget 2020 amendment, any other person prescribed for this purpose means authorized for this purpose can verify the return. In case of local authority, principal officer. In case of political party, chief executive officer. In case of AOPBOI, member or a principal officer. In case of any other person, the concerned person who is authorized to verify, competent person should verify the return. Yes, so this we have completed. Now we can quickly go through this practical questions, small questions. We will not read the solution. We will just refer the question and discuss the solution. All these questions are taken, 7 questions. All of them are taken from ICI module only. Up to last year, I was not taking up any questions in this chapter, but this year I have copied all this ICI module question, and I'm taking up in the class because in MCQs they can ask you anything for 1-2 marks. So point is why to take the chances. So question number 1 says explain with brief reasons whether the return of income can be revised under section 135 of the Income Tax Act in the following ways. Whether belated return can be revised. We have filed the return after the due date. Can we revise that return? Any return filed after the due date is called as belated return. Can you revise the belated return? Answer is yes. If you discover that there is an omission or wrong statement in that belated return, you can even revise the belated return. Return already revised once. Can it be revised? Rizwan, it is not necessary that you should appoint a chartered accountant or a lawyer to file the income tax return. You can yourself file your own return. You can file your own return. Everyone can file their own return, except when his books of accounts are required to be audited. If the books of accounts are not required to be audited, then you can file your own income tax return. It is not necessary for anyone to appoint a chartered accountant. But since there are a lot of complications in filing the return of income, that is the reason people go to chartered accountant. There is no other reason. So whether you can revise the return which is already revised, whether revised return can be revised. Answer is yes, you can revise the revised return also. How many times you can revise the return? Any number of times, but within the time limit. What is the time limit? Before the end of the assessment year or before completion of assessment by department, whichever is earlier. Whether the return of loss can be revised? Yes, return of loss can also be revised. Return of loss can also be revised. Next is question number 2. Mr. Paras, aged 55 years, is resident in India. During the financial year 2021, interest of 2,88,000 was credited to his non-resident external bank account with SBI. Do you remember? Interest on non-resident external bank account is exempt in section 10 clause 4. Totally exempt. 30,000 being interest on FD with SBI was credited to his saving account during the period. FD interest with the bank is totally taxable. If you are having FD with post office, then interest is exempt. Otherwise, it is totally taxable. He also earned 3,000 as interest on his savings account. Savings account interest with bank, saving account interest with bank is taxable, but yes, you can claim deduction under section 80TT or TTB. Here his age is 55 years, so he can claim deduction in 80TTA. Sarvana, not 80TTB, 80TTA. 80TTB only senior citizen can claim deduction. And 80TTB you can claim deduction for saving account interest as well as FD account interest. 80TTA non-senior citizen can claim deduction and only for saving account interest. So this saving account interest 30,000 is taxable under IFRS and deduction can be claimed under section 80TTA to the tune of 10,000 rupees. You also earned 3,000 as interest on saving account. Oh, sorry. This 30,000 is not interest on saving account. This is interest on FD account. This FD account interest is not exempt. It is totally taxable and this is also not eligible for deduction under section 80 TTA. Saving account interest is only 3,000. Sarvana, in 1015, FD interest is exempt provided you have kept FD and 54 exemption is exceeding maximum amount not chargeable to banks. That is, it is exceeding 2,50,000. Now we have to calculate his income. Income from other sources. Interest income on a non-resident external bank account is totally exempt. Interest on FD is 30,000. Interest on saving account is 3,000. Gross total income is 33,000. Deduction under section 80 TTA with respect to saving account interest. Here your saving account interest is only 3,000. So deduction will be restricted to 3,000. Total income is 30,000. So if you just look at the total income, then it is not necessary for him to file the income tax return. Since the total income of Paras for the assessment of 21-22 before giving effect to chapter 6 reduction is less than the basic exemption limit of 2,50,000, therefore he is not required to file the income tax return. In the above solution, interest of 2,88,000 earned from total income, that would be 321. In that case, it is higher than 2,50,000. In that case, he will be required to file the return. One more point, if he has incurred a foreign travel expenditure if he's incurred a foreign travel expenditure of 3 lakh on a foreign tour of sales spouse, he has to mandatorily file his income tax return on or before the due date. See, at the beginning of the chapter, this point I have explained you now. Foreign travel expenditure exceeding 2 lakh rupees. So in the question they have given how much expenditure? He has incurred a foreign travel expenditure of 3 lakhs. So it is more than 2 lakhs. So he has to file the income tax return irrespective of his income. So they are asking you two questions. Question number one, whether he is required to file the return. And number two, what would be your answer if he has incurred foreign travel expenditure of 3 lakhs? So in number two, your answer is what? Yes, he has to file the income tax return because he has incurred a foreign travel expenditure of more than 2 lakh rupees. Yes, is that very clear? Let's move on to question number 3. Mrs. Hethel, an individual engaged in business of beauty parlor, has got her books of accounts for the financial year ending 31st March 21 audited under section 44 AB. Her total income for the assessment is 3 lakh 25 3 lakh 35,000. She wants to furnish a return of income for the assessment at 21-22 through the tax return preparer. Can she do so? Answer is no. In case of individual, they cannot file their income tax return through tax return preparer if their books of accounts are audited. TRP can file the income tax return only for individual and HUF. That too only if their books of accounts are not required to be audited. So here Mrs. Hethel cannot furnish a return of income to a tax return preparer. Question number 4, point A. State with reasons whether you agree or disagree with the following statement. Point A. The return of income of limited liability partnership could be verified by any partner. Yes. In case of limited liability partnership, who can verify the return? A designated partner can verify the return. Or where there is no designated partner, any other partner who is authorized for this purpose can verify the return. Either the partner should be a designated partner or he should be an authorized person. So any partner cannot verify. Either a designated partner can verify or a partner who is authorized to verify can verify. So we don't agree to the statement. Return of income of LLP shall be verified by the designated partner. Any other partner can verify the return of income of LLP only in following cases. Number one, where for any other unavoidable reason such a designated partner is not able to verify the return or whether there is no designated partner. However, with effect from assessment at 21-22, any other person can also verify the return if he is authorized for this purpose. If he is authorized for this purpose. So if any other person is not, any other partner is not authorized, he cannot verify. Point number B, time limit for filing return of income under section 131 in case of Mr. A having a total turnover of 160 lakhs for the year ending 30th March 21. Whether or not opting for presumptive income under section 44 AD is 30th September 21. Yes. What will be the due date of filing return in case of this individual? In case of individual whose books of accounts are required to be audited, due date of filing return is 31st October. If his books of accounts are not required to be audited, but he has done some international transaction, then 30th November. In other cases, 31st July. So we are writing the answer if Mr. A opts to offer his income as per presumptive section of 4480, then the due date for filing return will be 31st July because his books of accounts are not required to be audited. In case Mr. A does not opt for section 4480, then he'll be covered by section 44AB audit of books of accounts because his turnover is more than 1 crore. In that case, he has to get his books of accounts audited, and in that case, due date of filing income tax return will be 31st of October. So now we are left with 3 small questions. Question number 5, 6, and 7. Question number 5 says, Mr. Vinith submits his return of income on 12 September 21. See, whenever they don't give you the adequate information, you should write multiple answers. So that is what they have done in question number 4B. Since adequate information was not given, I have written answers on both sides because we do not know whether the SS is opting for section 4480 or not. So we should write 2 answers. If he is opting, then 31st July, not opting, then 31st October. Question 5. Mr. Vinith submits his return of income on 12 September 21 for the assessment year 21-22, consisting of income under that salary, house property, and bank interest. 2nd January 22, he realized that he has not claimed deduction under section 80 TTA in respect of his interest income on savings account. He wants to revise his return of income. Can he do so? Examine. Would your answer be different if he discovered omission on 21st April 22? If he has discovered the omission on 21st January 22, then he can definitely submit the revised return because the time limit to furnish the revised return is before the end of the relevant assessment year or before completion of assessment, whichever is earlier. The date of completion of assessment is not given to us. Therefore, we should take end of the assessment year, which is 31st March 22. So if he has discovered the omission on 21st January 22, he can revise the return. But if he has discovered the omission on 21st April 22, then it is after 31st March 22, he cannot revise. Is that very clear? Yes? Since Mr. Vinith has income only under salary, house property, and other sources, he does not fall under the category of persons whose accounts are required to be audited. Therefore, due date of filing return in his case is 31st July. Since Mr. Vinith has submitted return only on 12th September, said return is called as belated return. As per 135, a return furnished under section 131 or belated return under section 134 can be revised. Thus, a belated return can also be revised. Therefore, Mr. Vinith can revise the return of income filed by him under section 104 in January 2022. January 2022, you can revise the return and claim the deduction under section 80AA. Since the time limit of filing the revised return is up to the end of the assessment year, which is 31st March 22. However, he cannot revise the return if he has discovered the omission on 21st April 22, since it is beyond the date 31st March 22. Is that clear? Yes. Dikshit, end of relevant assessment year means last day of the assessment year. What is your assessment year? Dikshit, assessment year 21-22, no? What is the last day of the assessment year in your case? What is the last day of the assessment year? 31st March 22. So you can revise the return up to 31st March 22. That is called as the end of the relevant assessment year. Let's move on to question number 6. Examine with reasons whether the following statements are true or false with regard to the provisions of Income Tax Act 1961. The assessing officer has the power to allot PAN to any person by whom no tax is payable. Can an officer suo motu allot the PAN number to you? Answer is yes. So as per section, this statement is true as per section 130 and A subsection 2. This section provides the power to the assessing officer to allot the PAN number to the assessee suo motu, having regard to the nature of transaction which that assessee has entered. So, having regard to the nature of transaction, assessing officer may allot the PAN number to any person, whether any tax is payable by him or not, and that is required to be allotted as per the prescribed procedure. Dikshit is asking a question whether completion of assessment may change from case to case. Yes, it can change. Definitely it will change. But in this question, in the earlier question, they did not give us the date of completion of assessment. That is the reason we only took end of the assessment year. That's all. If they give us the date of completion assessment, we can take that date also, and then we can find out which was earlier date. Let's move on to question number 6, point number 2. Whether the Karta where the Karta Vachu is absent from India, return of income can be verified by any male member of the family. So this is incorrect. It can be verified by which member? Any adult member. Any adult member. So this statement is false as per section 140 clause B. That section provides that where the Karta Vachu is absent from India, the return of can be verified by any other adult member of the family. Such member can be a male or female member. That is what I told you. Question number 7. Explain the term return of loss under the Income Tax Act 1961. And can any loss be carried forwarded even if return of loss has not been filed as required? Yes. What do you mean by return of loss? Return of loss means the income tax return in which you are declaring a loss. The income tax return in which you are declaring a loss. Your losses cannot be carried forwarded if you have not furnished the return within the due date given in section 130 and subsection 1. However, certain losses will be carried forwarded even if you have furnished the return after the due date. Which are those? Losses under income from house property, unabsorbed depreciation, unabsorbed capital expenditure on scientific research, and unabsorbed capital expenditure on family planning. This can be carried forwarded even if you don't furnish your return within the due date. So this says a return of loss is the return which shows certain losses. Section 80 provides that losses specified therein cannot be carried forwarded unless the losses are determined as per the return filed under section 130 and 3. 130 and 3 says that to carry forward the loss, the return should be filed within the due date given in section 130 and 1, which can be either 31st July or 31st October or 30th November, whichever is applicable to you. Following losses are covered by section 130 and 3. Business loss, loss from speculation business, loss from non-speculation business, loss from specified business, losses under capital gain, and losses from the activity of owning and maintaining resources. All these losses, if you want to carry forward from current year to the next year, you have to furnish the return within the due date. You have to furnish the return within the due date. If you don't furnish the return within the due date, then what will happen? Then we will not allow you to carry forward the loss. We will not allow you to carry forward the loss. However, losses, yes, if we don't allow you to carry forward the loss, definitely it will lapse. It will lapse. However, losses from house property, unabsorbed depreciation, this can be carried forward even if the return of income is not furnished within the due date. Along with unabsorbed depreciation, you should also remember unabsorbed capital expenditure on scientific research and unabsorbed expenditure on family plan. This can be carried forward even if you have not furnished the return within the due date. Yes. So with this, our return of income chapter is also over. Yesterday, I gave you two practical questions on 115 BSc that we'll discuss. Question number 1. Mr. X, age 37 years, is a businessman. His income for the previous year 2021 from business is 14 lakhs. Besides that, he has earned interest on saving account 21,000. He annually contributes 1,50,000 to the public provident fund. For this, he can claim deduction where in section 80C. Mr. X wants to know whether he should opt for alternative tax regime for the assessment at 21-22. First of all, please understand that Mr. X is having a business income. So, if he opts for alternative tax regime, he will have to declare income in all the subsequent years also as per the alternative tax regime of section 115 BSc. If he takes the exit from the section in the future years, then he will not be allowed to re-enter into section 115 BSc unless and until he has stopped his business. His business is discontinued. So he can furnish the return of income and he can declare income. He can calculate the tax by alternative tax regime. That is okay, but he have to stay in that section in future period also. So now what you will do now? You will calculate his total income and tax liability by both the mechanism. By both the mechanism. Existing tax regime, alternative tax regime as per section 115 BSc. First of all, let us look at the existing tax regime. His business income is 14 lakhs. His interest on savings account is 21,000, and this saving account is with bank, so entire interest is taxable. But yes, 80 TTI deduction will be available to the tune of 10,000 rupees. So here he can claim section deduction under section 80C for amount contributed to public provident fund 1,50,000 and savings account interest deduction he can claim in section 80 TTA to the tune of 10,000. From 14 lakh 21,000, you deduct 1,60,000. You deduct 1,60,000. That will be 12 lakh 61. Correct? 12 lakh 61. Now on that 12 lakh 61, you calculate the tax liability. On income of 10 lakh, your tax liability will be 1,12,500. Above that, on 2 lakh 61, you calculate tax at 30%. So your basic tax will be 1,90,500. Your basic tax will be 1,90,500. On that, you should apply the surcharge if applicable. Deduct the rebate under section 87A if eligible. 87A rebate is not available because income is more than 5 lakhs. Surcharge is also not applicable because total income does not exceed 50 lakhs. So you just 4% cess. You apply 4% cess. Final amount of tax liability will be 198,432. You can round off this to the nearest multiple of 10 rupees. So that liability will be 1,98,430. 198,430. This is as per the existing tax regime as per the normal tax laws. Now you go for alternative tax regime. If you go for alternative tax regime, you cannot claim this many deductions and exemptions. You cannot claim this. That you have to keep in mind. Can you claim ATC? No. Can you claim ATGTA? No. Chapter 6 deduction you can claim just 3 deductions: ATCCD subsection 2, ATJJA and ATLA. That's all. So his income from business profession is 14 lakhs. Other sources is 21,000. Gross total income is 14 lakh 21,000. No chapter 6 deduction. So total income is 14 lakh 21,000. You apply these slabs and calculate the tax on 14 lakh 21,000. Apply these slabs and calculate tax on 14 lakh 21. How much it will be? Up to 2 lakh 50, no tax. From 2 lakh 50 to 5 lakhs, 5% tax. That is 12,500. Yes, please calculate and give the amount to me. Calculate that amount. I'm giving you 2 minutes time. Please calculate. Yes. 167,750. Yes, everyone is getting the same answers. 4% health and education says that is 6,710 rupees. 6,710 rupees. And your tax liability will be 174,460. Yes, is that very clear? Yes, okay. Tax liability of Mr. X is lower in alternative tax regime. He may opt for it by uploading the option under section 115 BAC subsection 5 for the assessment at 21-22. Since Mr. X, now we have to ascertain the taxable business income. This is net profit as per profit and loss account only. Debit side of profit and loss account includes following: contribution given to National Laboratory for claiming deduction under section 35(2)AA. This is allowed as deduction. In section 35(2)AA, it is already debited to profit and loss account. Up to last year, weighted deduction was allowed. Now only normal deduction is allowed 50%. Sorry, 100%. So that is already debited to profit and loss account. So this 40,000 is already deducted while computing 7188. Further, it says point number B, revenue expenditure on scientific research relating to business of X for claiming deduction under section 35 subsection 1 clause 1. This also we have to ignore because already while computing 7188, this is already deducted. Cash payment of bill of 35,000 rupees. Cash payment exceeding 10,000 are disallowed, na? Cash payment exceeding 10,000 are disallowed in section 40 apply subsection 3. So this should be disallowed. You can put the plus sign here. You can put the plus sign. Yes. Have you understood this? Let's move on to the next paragraph. Credit side of profit and loss account includes following: dividend income from Indian companies. This is definitely taxable, but under IFRS, Our job is to first of all create the business income. So we will deduct this and we'll take it to IFOs. So put the minus sign here. Further, it says refund of income tax pertaining to the assessment year 1819 without interest 2000. See, when you pay income tax, it is not allowed as deduction. So when you get the refund on income tax, that is also not taxable. But along with the refund, if you got the interest, then interest on income tax refund is taxable. Interest on income tax refund is definitely taxable. But here there is no interest. This is without interest only. No, Deva madam. This 2000 is not interest on refund. Huh? This is amount of income tax itself. Income tax refund. Interest is not given in the question. It clearly says without interest. So this 2000 will not become taxable. So this dividend income you have to deduct 95,000. This 2000 also you have to deduct. Against both these points you put the minus sign. X is entitled to claim the following deductions which are not debited to profit and loss account under the existing tax regime for the current year. Additional depreciation, it is not debited to P&L, he is entitled to claim. So what should we do? We should put a minus sign. This should be deducted. Donation given to Prime Minister National Relief Fund. This is allowed in section 80G category A. This is allowed in section 80G category A. Deduction available under section 80JJAA 80,000. In the normal regime, this can also be claimed. Deduction under section 80C, 80D and 80E as well as 80EEB. 1,70,000. So that can also be claimed. So first of all, let us calculate income as per the normal provision. First of all, you take 7,88,000 in the calculator. 7,88,000. To that you add this 35,000 cash payment. Then you deduct 95,000. Then you deduct 2,000. Then you deduct additional depreciation 60,000. What is your PGBP income? Yes. ₹70,66,000. Sarvana, you have to take 71,88,000. To that you should add 35,000. From that you should deduct 95,000, 2,000 and 60,000. How will you get 6,56,000? Deva madam has calculated. ₹70,66,000. Parvez has also calculated 70,66,000. So 70,66,000 is the correct business income. 70,66,000 is the correct business income. Now we should take income from other sources. Income from other sources, you are having only one amount, dividend income 95,000. To that 70,66,000, you add up 95,000. You will get what? 71,61,000. 71,61,000. From that you claim chapter 6 reduction. 80C, 80D, 80E, 80EB 1,70,000. 80G 20,000 and 80JJAA 80,000. So 170, 80 and 20 all deductions you can claim. 170, 20 and 80. So from 71,61,000 you deduct 170, 20 and 80. The balance amount will be how much? 68,91,000. 68,91,000. Now you calculate the tax liability on 68,91,000. You calculate the tax liability on 68,91,000. What will be the tax liability on 68,91,000? How much will be the tax liability? 1879 800. Because also, Sarvana, what amount you have written? 21 lakh 50,490. 21 lakh 50,491. This will be rounded off to 21 lakh 50,490. That is correct. That is correct. Yes, all of you have understood the calculation of tax liability. Yes, okay. Now let's move on to alternative tax regime. Alternative tax regime. See, these deductions are not allowed if you go for alternative tax regime. You cannot claim these deductions. See, these are related to TGVP chapter from point number 12 to point number 18. Additional depreciation not allowed. Normal depreciation will be allowed. Additional depreciation will not be allowed. Investment allowance, anyway it is expired on 31 March 20. 33 AB, 33 ABA. Scientific research, section 35 2 AA, etc. 35 AD specified business. Agriculture extension project 35 CCC. All this reduction will not be allowed. So 7188 is net profit as per profit and loss account. To that we are adding back contribution to National Laboratory for Scientific Research 40,000. Revenue expenditure on scientific research 30,000. Cash payment exceeding 10,000. 35,000. This we have added 70 to 93. Dividend from Indian companies we are deducting because it is taxable under IFOs. Income tax refund is not taxable. That is the reason we are deducting. Additional depreciation is not allowed. Deduction under section 35 2 AA contribution to National Laboratory is not allowed. See here, if you refer to this very carefully, then scientific research, capital expenditure is not allowed. Scientific research, revenue expenditure will be allowed. Scientific research, revenue expenditure is covered by section 35 subsection 1 clause 1. Here they have mentioned section 35 subsection 1 clause 2, clause 2A, clause 3 and section 35 subsection 2 double. This is very important point. If you want, you can write here. Revenue expenditure on scientific research will be allowed as section, and that revenue expenditure on scientific research is covered by section 35 subsection 1 clause 1. That is the reason we have claimed deduction here for 30,000 rupees. Revenue expenditure on scientific research. This 40,000 we have not claimed because it is covered by section 35 subsection 2 double. So this 30,000 you deduct here. 35 2 double is not allowed. So are you getting 71 lakh 66,000? Yes, you should get, because two amounts are not taken here, 60 and 40. So there is a difference of 1 lakh. Your income will increase by 1 lakh. Your income from other sources 95,000. So your total income, gross total income will be 72 lakh 61,000. 72 lakhs 61,000. If you go for alternative tax regime, chapter 6 deduction not allowed. So this 170 will not be allowed. 80G also not allowed. But again, can you claim deduction for 80JJAA? Yes. 80JJAA is allowed. So I am deducting only 80,000 here. So 72 lakh 61,000 minus 80,000 is 71 lakh 81,000. 71 lakh 81,000. Now we calculate tax liability on this 71 lakh 81,000. Calculate tax liability on this 71 lakh 81,000. Yes. $71 lakh 81,000. Calculate the tax as per which rate? As per alternative tax regime. Parvana, as per 115 BAC, you have to calculate. 1891 800. Have you added surcharge and cess? Because even if you go for 115 BAC, your surcharge and cess will remain the same. You add surcharge, then you will get the amount of basic tax plus surcharge. To that you add health and education cess 4%. Sarvana has given me the answer 21,64,220. 21 lakhs 64,220. Deva madam has given the answer 21,64,219. So that is rounded up to 21,64,220 only. Yes. Basic tax will be 1891 800. To that we will add 10% surcharge. That is 189 180. We'll get 20 lakhs 80,980. To that we'll add 4% cess 83,239. And we'll get the amount of final tax liability as 21,64,219. This will be rounded up to 21,64,220. So which option is beneficial? Definitely the normal tax regime, existing tax regime is more beneficial, because in that case tax liability is only 21,50,491. So since tax liability of Mr. X is lower under the existing tax regime, he is advised to opt for existing tax regime. He should not opt for the alternative tax regime. Yes, is that very, very clear? So we have completed the discussion of section 115 BAC. With this, our syllabus is entirely over. 2 chapters I have told you. Clubbing and set off. Clubbing chapter, entire theory as well as all the practical questions I have recorded. That recording is already uploaded on the Insight app. Some of you might have already referred to that. Set off chapter, entire chapter theory is recorded. Entire chapter theory is recorded. Practical questions, 4 or 5 practical questions are there in the set off chapter that I have not recorded, but I'll record from here. I'll record and send it to them. They will edit it appropriately, and that practical question on set off will also be, solution will also be uploaded in video form. That also you can refer. Even after referring clubbing and set off chapter from the video, if you are having any doubt, you can note down the doubt. The day on which you are watching the video, on the same day, you note down the doubt and you ask me the doubt. You drop me the message or call me. If I am in a lecture, if I don't pick up the call, I'll call you back. Yes, is that very clear? Thank you everyone. Bye bye.